would have better things to do. But yeah, but we also know that you're writing soon, which is 21st of July. So you also want to get an understanding of, of the topics that you are struggling with. I see Kay Governor have her hands up. Do you want to ask a question? Okay, I think that was probably a mistake. So the session is being recorded for those students that are joining, and I'm going to put it on the eTutor site. So I thought before the session, I'm just going to show you the eTutor site, because on this eTutor site, it's this, it says 25Y4E. So on this eTutor site is where I post everything and anything that I want to post. So you'll see at the beginning, it's a welcome page. My personal WhatsApp number is there. My personal Yahoo is there. Then I have announcements, just general announcements. Then there's additional informations and everything basically like around 102, 102, 103. I usually ask students for feedback. Then there's also 104 and test discussion. If you look at additional resources, what I do is I post an announcement to say I did this, and it's on the in the additional. So okay, there's admin docs, there's a past test, but I have summary notes of 102 of every lesson. So I have summary notes of every lessons, and then if I feel there's a need to explain like something like what is magnitude, likelihood, and spectrum, I have it there also. Summary notes of 103, summary notes of 104. Then I have, if there's any specific content in all the tag letters that I want to have slides, I usually have slides like additional to the summary notes. Then I have videos recorded as well around like tag letters. I never did really I did for 103 some. I didn't do anything for 104, but I'll add now this to 104 basically. And then of course there's some, so these are videos, and then we have the tutorial letter 104 content. So you'll see there's business, what's like, so in business risk versus normal risk for material statement, you can see what's the difference between that. And then I just have some guidance on approaching acquisition and payment cycle, revenue and receipt cycle. So this is the type of things you'll find like under the additional resources. Then I can show you the type of things I would put in like under each tutorial letter discussion, because usually I will just state that like here I have a guidance on flagging and highlighting your King 4 book, for example, for tests and exams. Then I'll say summary notes is like, if you go in here, you'll see that under additional resources is summary notes. Then it will take you to the and so forth. So you can play around on the system. If there's any videos, because some of these videos is nice short, like a 30-minute videos, and then you can see like where I went through questions, and I will tell you which question in which tutorial later, etc. Is everyone fine for now? Can I continue? Was that helpful? Does anyone have questions around the site? Okay, then just a disclaimer. So I have my site as an e-tutor, and then your lecturers have their own site, which is this one over here, 25Y. So it's also important not just to look at my site, but also to look at your lecturer sites, because your lecturer, because sometimes what I do is I would link, I'm sorry, I would link what the lecturer said. Like for example, they do live sessions as well. Then I would say, please go see this live session on this link, and I link it to your lecturer's site, because they also have classes where they explain content and stuff, and where they also go through questions. So all of that you should also watch, and they have additional questions on top of your tutorial assessments. And it's very important to do those self-assessments in your tutorial later, because those are past papers and so forth. So anyhow, so that is it. And then just a little about myself. So I'm Tamina Abrams. I'm a chartered accountant. It took me 14 years to become a CASA. I've studied through UNISA, my undergrad and postgrad, from 2008 until 2019. So it took me 10 years to finish my undergrad and postgrad through UNISA. Then I did my board one, which I passed on second attempt, and board two I passed on second attempt, and then I became a CA in 2022. I'm an e-tutor for UNISA since 2022, and I lecture also at the University of Western Cape. So that's just a little bit about me. So now, as everyone wanted, they said that they want to go through, I went to do this poll on WhatsApp, and they said they want to go through lesson 3. Okay, so can everyone see my slide on lesson 3? Can just someone say yes? Because I can't see the screen where you guys chat.
Yes, I can see it.
Okay, thanks. So lesson 3 is about planning and audit, right? So the objective for this session is basically understanding what's an audit risk and its components. So by now you should know this formula, which is AR equal to IR, which is inherent risk. So as audit risk is equal to inherent risk plus control risk and detection risk. But we're going to go more into detail about that. We're going to explore risk of material misstatement at an overall financial statement level as well at an assertion level. We're going to distinguish between inherent control risk and detection risk. We're going to have some clarity around what's audit strategy versus audit plan. Then we're going to just look at calculating planning and performance materiality. And then there is something called clearly trivial. You need to never tested that, but we can go through it. Then at the end of each of these points, we're going to kind of apply this concepts then to a scenario. Okay. So like when we're done with, for example, us at the overall financial statement level and at the surgeon level, we're going to actually do a example. So before we proceed, right, it's important to know what are we doing, like where does all this stuff fall in. So as you must know by now, according to your tutorial letter 1 or 2, this is on page 5, you have an audit process. So there's stages. It goes from stage 1 to stage 4. Stage 1 is preliminary engagement activities. That is when you have to decide, do we accept or reject a new client or an existing client. So that is around lesson 1 to 1 and 2. So because even though you have an existing, maybe you audited the client last year, but now you must audit the client for the next financial year. But that something could have happened where that client's integrity is now questionable. And as a company, you don't want to be part or you don't associate with that client. So then you can still reject the client even though they were existing. So stage 1 is all about determining, do we accept or reject even new or existing clients by looking at our own resources as well as the management's integrity and all that stuff. But you guys should know this by now. Then when you decide you're going to accept whether a new or existing client, then you now know, okay, we're going to accept, and then you must give an engagement letter. It's like a contract saying that this is what we're going to do for this client. This is the name you're going to audit. This is the auditor's responsibilities, your client's or management's responsibility. You can discuss audit fees in there. You give that letter. That letter gets signed, and then you go to stage 2, which is the planning of an audit. Now, the planning of the audit is what we're going to discuss, and it's all those things that we discuss. What was the objective of the session. And because remember, it's like even it's like a wedding, for example, you don't just go and get married. You have to plan it. You have to be strategic about the planning of your wedding, and you have to plan it. You have to see, okay, what resources do I need? Do I need a wedding planner? Do I need caterers? Do I need flowers and all that stuff? So that's what the auditor basically do. So you plan the audit, you first go see what risk is there, where is the risky areas, you understand its environment and all those things before you go and go audit. Because once you plan, once you do the audit strategy and the plan and all of those things, then you're going to go to stage 3, which you would now have to obtain the audit evidence, meaning you're going to now perform the test of controls and the substantive procedures to you gaining now the evidence by looking at inspecting documents and stuff. Because remember, what's the whole idea from stage 1 to stage 4 to concluding is our duty, or what we want to do as auditors is we want to provide an audit opinion on the financial statements of the company. Because we then that opinion, you're going to do more about opinions in stage 4, the different opinions you get, because basically we need to tell stakeholders of that financial statements that the financial statements is free from material misstatements and provide a reasonable assurance. When we say reasonable assurance, we mean that we audited to the best of our ability using a sampling methodology, and that reasonable means that we audited to the best of our ability. There might still be misstatements, but we are fine with what misstatements they are, as maybe immaterial misstatements. Then you get something called absolute assurance. We as auditors don't provide absolute assurance, because absolute assurance means we 100% audited the financials. And remember, we don't 100%, we do sampling. So in order for us to determine what opinion we're going to give on that financial statements at the end of the day, to come to stage 4, we have to address all of these stages. So for lesson 3, we are basically in stage 2. We now plan in the audit. We can't just jump in. We accept the client. We can't just go audit. We can't go straight to stage 3. We need to understand its environment, its internal controls, know where's the risk, etc. Happiness. Let me escape here? Maybe I can see. Does everyone understand that process? So that's just a bigger picture. You can thumbs up. Must not if I'm going too fast, eh? Okay, I see someone is typing. You can repeat. What should I repeat? Let's see. Am I moving fast? Okay. So let's slow it a bit down. So when it comes to the audit process, all right? So the main objective of an auditor is to audit the financial statements of a client in order to provide an audit opinion at the end of the day. And that is an opinion that will end up going into the conclusion when we issue the financial statements. And in the financial statements, you'll get something called an auditor's report. In the auditor's report will tell the stakeholders that we are of the opinion that that this financial statements of this company is free of material misstatements, and we provide, for example, an unqualified opinion. But the thing is, don't worry now about opinions. You get different opinions because some audits are not clean audits, some have issues, and we have to address those issues. But in order for us to come to that opinion, to come to stage 4, but you guys won't know yet what stage 4 goes. That's only in tutorial letter 104, 105, the next tutorial letter. In order to come to that opinion, we first have to go to stage 1. We first have to determine, do we accept or reject a existing or a new audit client? Because like I said before, a, if you have an existing client that you did audit in prior year, things can come alight of that client where, for example, maybe the management's integrity is now questionable in the sense that they might maybe they're in a scandal. So as an auditor, even though they were our existing client last year, I'm not going to go and audit them again this year because I don't want to be part of that scandal or part of that audit or being the auditor. So it'll be too much risk for me. So in stage 1, an auditor determines, do they accept the client or reject the client, whether it's a new or a old client, whether it's a new or an old client, basically. Once you say you're going to accept the client in stage 1, you issue an engagement letter, which is like a contract that will state that this is now the objective of the audit. This is auditor's responsibility of the audit. Then they give the management's responsibility of the audit, and they also provide like the audit fees in this engagement letter. This engagement letter basically is going to state we're going to start auditing. Once the engagement letter is issued, then an auditor will now go and plan the audit. Because as you can't just as an auditor, you can't just jump straight into gathering evidence. You first have to, in the planning stages, you have to kind of do all these objectives first in order to now say we're going to obtain or go to stage 3. Because stage 3 is about doing or gaining audit evidence through substantive procedures and test of control procedures. So in planning of an audit, you look at the audit strategy. So for example, say you're getting married. Your strategy would be like, when will be the timing of the marriage? Your scope will be, for example, like maybe okay, we're gonna go through, but like whatever the scope is gonna be of the wedding, and then you look at the nature of the wedding and all those stuff, and then you're gonna end up doing the planning of the wedding. Now that's now the specific planning of the wedding when it comes to how much flowers we need and all those things and whatever the case might be. The strategy would be more: do we need a for example, a wedding planner, a caterer, and all those things, and so forth. So those are part of the planning. Okay, so the execution would be our next sessions, which will happen on Sunday night and Tuesday night. So that would be around the actual gathering now, the information. Because remember, you have to gather the information now and start auditing and collating your findings or putting your findings together in order to conclude and report, in order to issue that audited financial statements with that audit opinion. Does that make sense? Was that a bit better, Quentin? Okay, so you understand the process. So we're basically in stage 2 now of this process with lesson 3. Okay. So now, like I said, In the audit plan, right? You have to now look as an auditor. You have to now look at the client. You accepted this client, right? As an auditor, you now have to determine or understand the client's environment, how they operate and all those things. You have to also look at what risk are there for the client, right? Because based on the risky sections that you identified as an auditor, you will end up, for example, in this stage of a year, in stage 3, then if for a risky section, you would audit more. And for riskier section, you have different direction of how you're going to audit and so forth. Okay. So when we speak about risk, right, you have this thing called audit risk. So what is an audit risk? An audit risk is that the auditor might express an inappropriate opinion, meaning an inappropriate opinion when it comes to the concluding part now in stage 4. Don't worry about what opinions you have thus far because you're going to learn more about opinions in TAT 105. So that is an audit risk, right? But there's a formula behind audit risk. Audit risk is equal to inherent risk plus control risk and detection risk. Now, inherent risk and control risk together is called risk of material misstatement. Now, inherent risk is risk that affects the financial statements before taking into consideration any internal controls the company have. So things that just affect the business as a whole or that can impact the financial statements as a whole before looking at internal controls. Now, the control risk is now looking at risk that affects the internal controls. Because if a company say they have they have segregation of duties, for example, maybe one person, for example, look at maybe EFT payments. One person will initiate the payment, the other person would release the payment. It means two separate people doing that duty. So if a company says that's an internal control, the company is saying this is what we're doing. So the company says that's what they're doing, but now as an auditor, you go test that control. And then you see, but the person that created the payment also releases the payment. What does that tell you? Did that control work? Was that control effective? Can anyone tell me? Because in that situation, it means that the control was ineffective. So then it means the control risk would be high because it means that the control failed and it's ineffective. So that's what is meant by control risk. I use this analogy on WhatsApp and also I pasted it on the announcements about the gate. If, for example, if a homeowner say they have the security gate in front of the door and it locks and it's in working condition, that's an internal control because that's a control that is saying we have a working gate that will secure us and make us safe. So if you go and inspect that gate and that gate can't lock, it means that the internal control is not working the way it should be working. Does that make sense? Okay. So these two, inherent and control risk, that is risk of material misstatement. Then detection risk is what the auditor might possibly fail to detect. Because remember, as an auditor, you only know what the client tell you or what you pick up from the financial statements. So there's a high possibility that some things can go undetected by an auditor. So that is meant by detection risk. So can you tell me? Can you see what between these three, which one is in the control of the auditor? Can anyone tell me? I see I see as assist the engagement. It includes the areas of auditing like we will audit HR, finance, etc. I'm going to respond now to that question. Let me respond to that question. So, an engagement letter, it is in one of it should be in the internal standard of auditing. There should be a appendix within the internal standard of auditing to show how an engagement letter look like. An engagement letter usually would state, like it will say, we, the auditors XYZ, will be auditing the financial statements and like the statement of profit and loss of the statement of financial position for this company for this year in. Then it will have a heading that say responsibilities of the auditor. So it will say, what are we going to do? So like to say, what is our responsibility? I will give the responsibility of management because your client is responsible to make all the information available to you. So like, so they basically everything relating to financial thing, that anything that relates or that impacts your financial statements is what you're going to end up doing as an auditor. So all that stuff will be, but you don't necessarily have to be specific in there to say we're going to audit revenue and all those things, because it's implied you're going to look at the financial statements and everything that impact the financial statements and so forth. I hope that could answer your question, Matipe. Okay, so coming back now here. So as you can see, so the auditor has got the control around detection risk. So if the auditor fails to detect something, then it means the detection risk will be high. So the formula for audit risk is equal to basically all three. Makes sense? Does that make sense, everyone? So now let's go into inherent risk versus control risk. So remember, I told you these two is basically equal to risk of material misstatement. So when you look at inherent risk, it is, like I said, it is what, like anything that can go wrong within a business that can affect the financial statement as a whole before taking into consideration the internal controls, because the internal controls is basically your control risk. So this is any risk or risk that the controls, whatever controls the company say they have, won't prevent or detect any errors or fraud, for example. Because if, for example, if the company say they do that specific internal control, then it means that by doing that control will prevent, for example, by having two people two segregation of duties, by having one person create the payment and someone else release the payment, reduce that control reduces the risk of any errors happening and of any monies being stolen, because someone who create the payment can end up repaying themselves if they must be releasing it as well, or you must have someone authorizing the payments. So like I said, your example is no segregation of duty, but for inherent risk there is a nice set of examples in ISO 315. I'm going to show it now to you. So in the ISO 315, Appendix 2, they explain what's complexity, subjectivity, and all that stuff. But here there's a page of examples of indicators of inherent risk. And here, for example, under complexity, they speak about regulatory, so operations that are subject to a high degree of complex regulations. So there you think of if they JSE listed and so forth. Here they speak about business model, if there's existing or complex joint ventures. So you think of group companies. So you see, so whenever, for example, they ask you to describe inherent risk factors, then you must basically look and think of these factors that they provide examples for. Then it goes on, like financial reporting frameworks. Maybe there was a change in accounting standards and they have to implement these new standards. Complex transactions. Then when they speak about subjectivity, subjectivity is all about estimation, subjective. Estimations is usually about your audit client, they produce, for example, they produce their, as based on estimate, as based on their judgment, so it's a subjective. So any accounting estimates would fall in this range, or any valuations that they have to do will fall in this range. Then there's change. There's economic conditions, for example, any unstable things happening in the economy. But you'll see as we do examples, it will pop up. Any customer losses, business model change, geography changes, expanding to new locations, changes to human resources, IT changes, capital changes, and so forth. Uncertainties, any events that that will create events that will create estimates, but we're going to go through that. Then of course susceptibility to fraud is more about, you'll always see that in a question. We'll see there's a possibility of of management doing something not so right here, and that's due to fraud usually. So you see, so the eyes of the International Center of Auditing provide you these lists of examples. So it's for you as a student now to, when you're doing a question, is to, before you even read the scenario, when you read a question and you see describe the inherent risk factors, or sorry, describe the risk of material misstatement at an overall financial statement level, these are the examples that must come to your mind. Then when you are reading the scenario, you start identifying it. Because remember, you can know all these examples, but you have to apply it to your scenario. Makes sense? But we're going to go through a scenario of how you can apply. This is a very nice, I love that that example or that appendix. Is everyone fine? You understand that appendix? Because that appendix give you all the examples of what inherent factors there can be within a company. Okay, but we're going to apply it so you can see it much better. Oh, the other thing I forgot to state is when we spoke here about customer losses, when we spoke here under change economic, when we speak about customer losses and market like expansion of business and so forth, you always think of one thing it must also trigger is there any going concern issues? Because what is going concern issues? Going concern mean is that a company will be able to trade in the next 12 months. It means their assets exceed their liabilities, they're making profits. So as soon as you see losses, and as soon as you see customer losses, or as soon as you see the liabilities exceed the assets, then those or economic conditions that will make them go into a loss, those should trigger going concern issues. Make sense? Can I move on? Let's see. Okay. So now, like we said, risk of material statement is IR and CR only. We went through overall financial statement at the overall financial statement level because you will refer to your ISA 315, which is your appendix 2, because that gives you an example, because that's basically what could go wrong that will affect the entire financial statements. When you look at risk of material statement at an assertion level, you're looking at what can go wrong for a specific line item within the financial statement, whether it be revenue, expenses, cost of sales, or in your financial position, which is your trade payables, trade receivables, and so forth. So as soon as you start discussing a line item, for example, if you must discuss overall financial statement level and you start speaking about revenue, then you must know you lost the plot because now you're in a surgeon level. Because now you ask yourself, what could go wrong within that specific line item? And now there's another, all these things that I'm showing you is on the UNISA site, right? Let me just make this, sorry. Is on the UNISA, let me just see. Is it this one? Like all these notes that I'm showing you is on the UNISA site, but I'm just trying to see if I can find the one for the, yeah, so I don't think I opened this one, yeah. So this is one of the notes, it says note 3.3, right? So where I explain that formula, what is this, those things, what's inherent factors and so forth. Then here, when it comes to assertion level now, so when you look at assertion level, so when you look at classes of transaction, this is usually your income statement, your income expense, you're looking at occurrence, completeness, accuracy, cutoff, classification, presentation. If you look at account balances, which is your statement of financial position, you'll see completeness is in both. Accuracy is in your transaction statement of a profit and loss, but for your balance, you must call it accuracy, valuation, and allocation. If you, for example, have to discuss a risk at a surgeon level and identify the surgeon for trade payables, for example, that's in your statement of financial position, isn't it? So if you're discussing issues around accuracy for trade payables, then you can't say the assertion is accuracy. Because if you tell your niece it's accuracy, they're going to mark you wrong. Because you're dealing with a balance, account balance, therefore you must say accuracy, valuation, and allocation to get that assertion mark. You'll see cutoff is only relating to class of transaction. So you'll see um, then classification is shared between the two, presentation is shared between the two. So you can see the assertions that relates to both ends is completeness, classification, and presentation. Accuracy, this is that difference where profit and loss is called accuracy, and account balance is called accuracy valuation and allocation. Then the other difference is we don't have cutoff for account for statement of financial position, but then you have existence and you have rights and obligation. So whenever you lose discussing risk at an assertion level, these are the assertions you are addressing when it comes to transactions versus account balances. Does that make sense? Makes sense. I'm hoping it's making sense. Okay. So now back. So that is basically the difference between the two. So now that you have, let's just see if I can make this bigger. Oh, that's too big. Now that you have now understand the difference between the two, right? Can you see this scenario? If you look at the two requirements, it's asking around the same thing, but it's asked differently. And I want you to be able to see what's the difference here. What can you see what they said in this was part of test 1 of 2024. It is on your on the lecture site, and I think I did put it on my on the eTutor site, term test 1 of 2024. They'll tell you with reference to the information provided in the case study, right? So what I like to do is I like to highlight what they're asking. Okay. So you basically break down the required. So what are they saying? They say for each of the inherent risks of material misstatement identified by Ross Naidu for the year end. So they are telling you already, someone has already identified the inherent risk of material misstatement for you, right? But based on what this person has identified, they want you to do two things. They want you to identify the inherent risk factors. So in this case, you need to know what's the inherent risk factors. And what are these? Those are inherent risk factors. Those are these ones over here. Your inherent risk factors is complexity, subjectivity, change, uncertainty, and this whole thing. You have to state this whole thing. You have to state this as susceptibility to management due to susceptibility to fraud due to management bias or other fraud or something to that effect. Okay. So when you read this question, when they say identify inherent risk factors, as a student, you really have to know those inherent risk factors that they exist, which is change. So which means based on what Ross identified, you have to state would what she identified, would it be change, would it be uncertainty, complexity, or whatever the case might be. Then the second part, they say, assess each inherent risk of material misstatement according to its magnitude and likelihood and spectrum, right? So now here you have to know what's magnitude, likelihood, and spectrum. So I have this on my UNISA as well. We are asked, what is magnitude? So magnitude refers to based on that inherent risk that Ross described to us. You have to say, you as an auditor, you have to determine what potential impact or significant would this misstatement be if it should occur. Would it be a significant impact? Then you must say, if it is a significant impact, you'll say high. If you feel it's not as significant, you'll say it's medium. If you say, no, it's not significant at all, it will be low. Then likelihood is how probable is it that this misstatement will happen. If you think it's highly probable this misstatement is going to happen, you'll say it's high. If you think, it's not as probable, you'll say medium. If you say, it's not probable at all, you'll say it's low. Then depending on what, if you say both is high, then you conclude spectrum is high. If you say both is low, then spectrum will be low. If both is medium, spectrum will be medium, and so forth. Okay, so that is how you do. And when you're discussing this, I'm now going to show you when we discuss it. When you're discussing it, you can't just say magnitude is high. You have to explain why you're saying it's high based on the scenario. You have to explain why you say likelihood is high or medium or low, and then you conclude based on the spectrum. Right. So that was required. I'm not going to go here through the scenario. This is required of 2024. Now look at the required of 2025. What are they saying here? Based on events or conditions in the entire scenario, identify the risk of material misstatement that arise at the financial statement level. So here you have to identify the events of the event or the condition, meaning it was in the scenario. So like what factors was there that shows that there's a risk for us? It's almost like the risk indicators. And for example, in this scenario, there was the imports of from China and so forth, right? So that's just taking it from the scenario. Then they say describe the risk of material misstatement at the financial statement level. Now, this description in B is basically what Ross gave us in 2024 was required. So that is the difference. Can you see the difference? And when you describe in the risk of material misstatement at an overall financial statement level, there's a structure that you need to use. You will always say the F's may be material misstated due to error, or you'll say the F's is material misstated due to fraud. Error is if it's unintentional, if it's just due to normal or like a normal risk factor, whatever the case might be. Fraud is if it's intentional. You'll usually see fraud coming in. For example, maybe there's going concern issues, so there'll be highly likely that management would fraudulently manipulate the financial statements to hide any going concern issues. So that is fraud. So it's intentional. So that's how you start off like that. You say as misstatement due to error due to fraud. Then you explain based on the scenario why, and you also give the impact it has on the financial statements. Does that make sense? Can everyone see the difference between the two requireds? Can I continue? Okay. Um. So now let us go to this Ross story, right? Always important, look at your mark allocation. I'm not sure if you know that you need to give you, for every 1 mark you write down, you get 2 minutes. So for example, it's 12 marks to do this table. It means you have 24 minutes to spend on this question, plus this 1 mark. Okay, so you have 26 minutes in total for this question. And you'll see you get 1 mark for identifying the risk factors. So if you say change, or whatever the case man, you get 1 mark for it. So which means you have one, two, and they say in there's three. So which means it's an indication that there was 3 issues that Ross did identify. So it's 1, 2, 3, and you'll see you get 1 mark for magnitude, you get 1 mark for likelihood, and 1 mark for spectrum. Okay. Now I would go straight to, so now we see Ross identified. You see, Ross identified already. Ross described the material misstatement at the overall financial statement level. Can you see that structure I told you? The S may be material misstated due to error or due to fraud. See, that's the structure. Then it says, he said, as due to error, as the going concern assumption may not be appropriate as indicated by the going concern inherent risk factors, such as the increase in expenses in feed, high interest rates, petrol load shedding, and the loss of sales due to bird flu outbreak. I'm not going through the whole scenario. We don't have much time. So what I did is, like for question 1, everything here. So if you see like green. So everything that's highlighted in green above relates to that um, in factor that she described already. Okay, so that first one, for example. So if you want a bit more content, right? So they are they Chase E listed. There was no changes in the reporting. They've been listed for since 2005. They have numerous agriculture sites. Um, the company declared losses for the very first time in 20 years. If you see stuff like this, you're really thinking of going concern issues. Then they had this whole load shedding issue and bird flu issue that is going to affect them. Then they said there's customers that struggling to pay their debts due to the economic environment, that the accounts receivable balance is increased significantly, and they say in the accounts receivable balance is material. They say in here that they comply with King 4, they have a audit committee. Oh, this part over here is about they want to, because of the challenges they face in, and they first are making loss, they want to also now go and diversify the product range. So they want to now go um go into new markets, for example. So see, these will all be inherent risk factors, but like Ross already identified it for you. So now relating to this first one. So with regard to this swine flu or to this bird flu outbreak, what do you think now would be the inherent risk factor for that first one? Do you think it is like Remember, it can be multiple. It don't have to be just one. It can be. Do you think there's change in that first one that Ross identify? Is it uncertainty? Is it complexity? Do you think it's a skepticism to misstatement due to management bias or fraud? Come on, guys, give me answers here. Remember, this is something that is out of this company's control. So they might have going concern issues because of load shedding and these increases in interest rates and petrol rates. Remember, that's out of the company's control, right? So remember, so there's a so the group it will fall under would be a bit of uncertainty, isn't it? Because based on these factors that's going to affect the business, the company is uncertain of how is it going to impact their business. And also on top of that, if there's a bit of so there's subjectivity, because remember, for them to determine how it's going to impact their business, they're going to have to make some sort of estimates, because it's difficult to estimate how a bird flu disease can affect their profitability. Makes sense? It can also be change, because there's a change to the environment of the business by having this high feed and interest rate and petrol and this load shedding and all the stuff. And also there's complexity, because I mean it's complex. Like, how do we determine now how is this going to impact? Now tell me something. Now that you're saying that's the inherent risk factors, right? Now you ask yourself, how significant do you think this is going to happen? Do you do you think this issue can significantly impact the financial statements of EPS? This is now describing the magnitude. So the magnitude in this case will be high. Reason being is because I'm going to explain. Magnitude will be high because this affects the company's operation or the business operation as in its entirety. It affects the going concern. There's a possibility that this business might end up closing because the field or the business that this company is in, or that I didn't explain to you, maybe I should have, is they deal with egg poultry. So they're in farming. So with the bird flu, it will affect their sales and stuff. So there's a possibility now they're not going to make those sales anymore. Okay. So therefore magnitude is high. So now, how likely or what's the probability of this happening now? What do you think? It will be high. Reason being, why do you say high? I connected this with why I'm saying it's high. It's because this is the first time they are declaring the loss in 20 years because of all these things happening. So you're going to say likelihood is high because it's the first time this company is declaring a loss for the past 20 years, and they want to now do this expansion of their business to increase profits by 20%. But at the end of the time, in the time that they do having these great losses, it's going to even maybe put more pressure on them as a business. Makes sense? And now then you conclude. So because of that, therefore you conclude that the spectrum of the spectrum is on the higher end of the spectrum for the inherent risk. Does that make sense? Yes, so I see people said complexity. So for this question, you could have said change, uncertainty, and complexity, but you only wanted one. So you could have said complexity, and you would have gotten the 1 mark. If you want to be that overachiever, you could have stated the 3, but they will still just limit you then to the maximum marks. Okay. And so forth. And you see how you said whether the magnitude was high, medium, or low, and you explain why based on the scenario. Okay. And you can see all those examples that came out of ISA 315 Appendix 2 is basically coming through from the scenario. Now the second one. Now she's saying, due to the overwhelming going concern factors, which was all this stuff happening here in the business with the swine flu and everything else, they say now the apps may be materialized due to fraud, to disclose a better financial position to hide the severe impact. Now, if it's due to fraud, what risk indicator do you think it will be? There's only one, guys. Whenever it's due to fraud, what do you see here? Is the susceptibility to misstatement due to management bias or fraud? Now you ask yourself, let's go back to the scenario. Now you ask yourself, what is the magnitude? How? What is the, again, how significant is the possibility that this will impact their financial statements? Magnitude will be high, won't it? Because they would want to misstate their financial statements to get a better financial position so they can hide that they cannot operate as a going concern in foreseeable future. The likelihood here is also high because they have so much going concern issues. So there, the possibility of management wanting to be motivated to have a healthy set of financial statements is high. The probability of them wanting to do that is high. And therefore, your spectrum will be on the higher end. Can you see how you discussing this? Last one now. Now this one, UNISA students kind of went a bit off on a tangent. So here they spoke about the material misstatement is due to error because the company may not comply with additional JSE reporting requirements. Now, when students see JSE listed, here's when a company must comply with JSE, it means that they must, like, for example, be profitable, their assets must be more than their liabilities, like they are finally watched by the JSE, right? But now you think magnitude is high, likelihood is high, and everything. But be careful. Always important to read other indicators within your scenario. So I linked the green to what other things. Now, what else do they tell you about JSE? Yes, we listed, but what did they tell you here? There have been no changes to JSE reporting requirements in the past for a few years, and EP is listed on JSE since 2005. Now, before we go to magnitude, and what do you think would be now the inherent risk factors for that one? For that, the fact that due to error, due to them being JSE listed. Any takers? Is someone telling me complexity? Because you are right. It is complexity. It can't be changed. Reason why it can't be changed because there was no new requirements recently, and they've been listed for a very long time. So that's a lot of time you'd say change is if you're auditing them now and they only became listed in this year you're auditing, then it's changed because it means they must get to understand and know how to do this change or implement it. Or if they state that there was a change, then you have to say change. So you're correct to say complexity, and of course it's not, the others is not applicable. Okay, so it was only complexity in this case. Now we discuss magnitude. What do you think would the magnitude be? So the okay, I see this. Okay, so someone said medium, right? It's not correct because remember, medium is not saying is kind of significant, and it's not high either because in this case, the it's not significant in nature. It's not going to affect the financial statement in nature. Reason being, so the magnitude is actually low. Reason being why the magnitude is low because what if the scenario further goes say? The scenario said that there was no changes to the reporting requirement. So whatever they've been reporting on since 2005, they are still reporting on the same thing. So this company will be clued up on the reporting requirements by now. They've been listed for so long. So the magnitude is low because there's no additional changes to the actual reporting. There's no new impact. There's no new disclosures, etc. Makes sense? If in the scenario they said there was changes made in this last few years, then you would say high. Makes sense. And then the likelihood is also low because the company has been listed on the JSE since 2005. So they know, they long listed, they know the requirements. It's only if they had to be listed from the year you're auditing, because then they'll be new to it. Then it will be high. Makes sense. So in this case, the magnitude and the likelihood was both low because of that reasoning only. And therefore, you can now conclude that the spectrum will be on the lower end. So you see how much you have to write for one mark each. So you explain why the high, medium, low, and you state why. And you take the why from the scenario. And like you can see, when you are reading a scenario, you don't just read based on this. Because if you read just based on that, you like you said, like students tell me now, it's high and medium because you didn't take into context the rest of the scenario where they spoke about the JSE. Makes sense. So you apply the other information to this to what was said as well. Makes sense. Everyone happy? Okay. So that is basically how you would have done that one, right? So you can see that is very different to this one over here. So here, the events here, you had to basically get it. So you can see everything in green was the events. So for example, you just had to take it from there. You had to say the imported goods comes from China, the spare goods. You had to say the finance and records are currently prepared by Mr. Tyke, and he's an engineer by profession. So what does he know? Okay. So these in green is all inherent risk factors. These in pink, if I'm colorblind, these are control risk factors. Remember, we had inherent risk versus control risk. This one over here in green is also a control risk factor because there's lack of segregation of duties. So I'm not going to go through everything because you have got the solution with you, right? But I just want to, for example, so for examples, take this one over here. So you identified that so the event is the finances and records are currently prepared by Mr. Tak, who is an engineer by profession. So that's the inherent risk event, right? So how would you now describe the risk of material misstatement and overall financial statement level? Remember, because he's not knowledgeable, it will be more due to error, isn't it? So you'll say the F's might be material misstated due to error as the financial statement is being prepared by Mr. Tyke, who is not competent and is not qualified, so he's inexperienced, and he might end up creating incorrect accounting records. Makes sense? Does everyone understand that? So explaining it is due to error and explaining why you're saying because he is not competent in order to do the financial statements, yet he's doing it. So because of his inexperience, he will end up doing or processing incorrect information within the accounting records. Okay. So that's how you discuss it. If you look here, for example, um, let's see another one. I'm not sure if that makes sense. Now, if you look at it, let me show you something. If you're looking for something due to fraud, right? This is more indicator of fraud. So Mr. Tyke, right, he advised the company needs to meet profit forecast and at any of all costs, right, in order to have good listing on CTSF. Now, CTSF is like a listing, like a JSE, whatever the case might be. So whenever, like we said in the previous example, they were listed for a very long time. You see, they want to now, in the current year, become listed. So in this case, the act may be material misstated due to fraud, as management would might manipulate the financial statements in order to be able to become listed on the CTSE. Makes sense. And when we say they're going to manipulate the financial statements, you can clarify to say they want to overstate revenue and assets and understate expenses and liabilities. Because remember, you'd want income and assets to be better and your expenses and your liabilities to be worse. Makes sense. The other fraud indicator here is you'll see that um, you'll see the other thing. Let's see. It was this. Let's see, where was that? Like, and whenever you see here, like here, they so the procurement manager who was invited to a meeting to discuss these procurement changes pointed out that this would not meet the specification requirements of the national regulator for compulsory specification. So they want to get cheap car parts at a lower quality. And this will be non-compliance to a law and regulation. Now, non-compliance to law and regulation can end up being a possible going concern issue because remember, if you are non-compliant to a law and regulation, there's a risk that you might end up paying fines and penalties for non-compliance with the laws and regulations, which will impact your financial statement as a whole. Makes sense? And so forth. But I'm not going to go through the rest of the examples. You can go through it on your own. But do you now get a better understanding of how you respond? Makes sense? Okay. Moving on. Now, if you look at an assertion level. So what I wanted you to see the difference between test 1 of 2024 versus test 2 of 2025. UNISA told the students in test 1 of last year, they said describe the result material statement at an assertion level for 1 mark that arise from the information provided in the case study and state the assertion. They said ignore by biological assets, but that's fine because that's actually non-examinable by psycho. Okay. It was for 7 marks. So here, if you get 1 mark for describing at assertion level, 1 mark for saying whether the assertion is completeness, accuracy, whatever the case might be, will give you 1. So basically, you're looking at 2 marks per issue. So which means you're looking at it to get 7 marks. You're looking to at least have 4 issues, isn't it? So there's 4 issues. So now look at required for test 2. Test 2 say risk of material statement at a certain level relating to revenue. Can you see the difference between the two? In the first one, UNISA never gave you an indication which assertion you're dealing with. If you're dealing with revenue, whatever the case might be. In test 1 of last year, UNISA wanted the student to read through the scenario and identify the significant items that is affected in that scenario. So there was a lot of significant issues in that scenario, right? And I addressed a lot of assertion or a lot of line items. Whereas in test 2, they specific only to revenue. So if you discuss trade receivables, you're not going to get marks because you just want revenue. In test 1 of 2024, they're looking at the whole scenario. Okay. So now we go to test 1. So what I did is everything highlighted in here you see in gray is what was significant as a student when you read it. So this is dark gray, so don't worry with the dark gray, worry with the light gray. So everything light gray basically would indicate something at an assertion level. Okay. So the fact that there was this issue that the cost of feeding for your poultry is going to increase due to interest rate increase in petrol, the load shedding, the bird flu, right? So that would have affected your sales, isn't it? So there you would have discussed now your assertions for revenue. Okay, because that is a significant impact for you. Okay, so there you'd say there's a risk that revenue might be overstated. Because remember, if there's this increase in expenses, right? So management would more likely would want to overstate revenue. Because I mean, who would want to understate revenue? So they're going to have fictitious revenue in their books. So therefore, there would be a risk that the revenue might be overstated due to this overwhelming going concern issues that you can see that's happening that relates to the increase of the costing. It's the first time they're declaring a loss within 20 years and all of those things. So you stating all of that. Okay. Then the other one is they say there the customers are struggling to pay their debts. So EPS customers can't pay their debts due to the economic environment. And they say accounts receivable balance has increased significantly. There again, you think they would want to overstate trade receivables. So you see, so the first part you can, so some significant assertion would be revenue, right? Or the significant line item here would be revenue. Then the next significant line item, as you read as a student, would be accounts receivable. Because they said accounts receivable balance is material. Then if you read on, they said, yeah, so what happened was there was a dispute with the lawyers. So the lawyers, after they had a fallout regarding the outstanding fees payable to the lawyers. So basically, EPS didn't pay the lawyers their outstanding fees. So if you have outstanding fees for for services already rendered to your client, it means that it will fix their trade payables. You see. One thing to note also is when you saw trade receivables, remember with trade receivables, the other accounts that will possibly be affected is allowance for credit losses and bad debts. The reason why allowance for credit losses, because remember, if you Now, due to the economic environment, there's a lot of customers that's not going to be able to pay their debts. As EPS now, EPS need to now first now create this assumption or this estimate to say, okay, from our current trade receivable list, how much percent of this of all of the entire balance of trade receivables do we think is not going to pay their debt? Then they'll maybe make the allowance 5 to 10% of the balance. So then they will create this allowance for credit losses. So that's an assumption amount. That's usually an estimate amount that the company would then estimate how much would not or would possibly default. Then the other account is bad debts. Now, what is bad debts? The difference between bad debts and allowance for credit losses is bad debts mean is we know from these trade debtors, we know debtor A is not going to pay us. We're going to write off debtor A immediately. If the debtor A owes 20,000 Rand, we're going to write off debtor A of 20,000. It goes straight to the expense. So you see, so bad debts is an expense account. Allowance for credit losses is a financial position account. Trade receivable is a financial position account. Revenue, so here it will be revenue that will be affected, it will be expenses that will be affected due to the high costs. Those are statement of financial position or transaction accounts. You see, reason why I'm identifying which account it is, because remember, you're going to have to go and discuss what assertions it affects. Make sense? So, for example, when we said that about there's a possibility that the revenue might be overstated, um, so that the revenue and assets might be overstated because the assets might be in a better position due to the going concern issues. So if you look at revenue only, this is the other rule is if you look at overstatement of revenue, the issue there would always be occurrence. Because overstatement of revenue means you are declaring more revenue than what there is actually is, meaning that there is fake or fictitious revenue. So that revenue that you are overstating by never actually happened. So whenever you determine it's an overstatement of revenue or overstatement of expenses, you always then the assertions relating to that would be occurrence. If you have an issue and you did identify that revenue might be understated or expense might be understated, meaning you are not recording all the revenue for the year that you should be recording, then that is completeness. Does that make sense? Now, the same apply with trade receivables. Remember, we said trade receivables, that there's a possibility they might not pay their debt. So they can overstate trade receivables because they said it's a material balance and there's a high probability the customer is not going to pay. So because trade payer receivables might be overstated, means they will put debtors there that don't exist. It's fictitious debtors. So it means as debtors that didn't also occur, but remember occurrence is not in for trade receivables. So for trade receivables, because it's under account balances, it will be existence because it means that that debtor didn't exist. Same with overstatement of trade payables. It means that creditor didn't exist. So therefore it's existence. If you look for understatement of trade receivables and trade debtors or whatever the case or trade creditors, then it will be completeness because it means not all the trade debtors and trade creditors was recorded in the financial statement. So it's incomplete. Does that make sense? So that is the rule behind when you want to determine is it occurrence, is it completeness or existence, whatever the case might be. Make sense? So I don't think I need to go further, but I think you can just go. So for example, so you see, so there you as a student you have to identify assertions based on the scenario. So like we said, revenue can be overstated. Assets could also be overstated. In this case, so there was occurrence issues, there was existence issues around trade receivables. Because again, we said they might be overstated due to them not being able to pay. Then allowance might also allowance now might be understated because remember by having an allowance in trade receivables, allowance reduces your trade receivables basically in essence. So a company would rather want to understate their receivables, which means it will affect more their completeness. Okay, makes sense. And then, of course, allowance might, because it's an assumption calculation, it's an estimate. So allowance for credit losses, so the risk at a certain level there might be calculated incorrectly due to it being an assumption or an estimate being calculated. And because allowance for credit losses are told in the statement of financial position, it will be, the assertion then would be accuracy, evaluation, and allocation. Then if we look at bad debts, and again, they'd want to understate bad debts. And remember, bad debts is an expense account. And what did I say about understating? If you say understate, it means that all the bad debts that should have been recorded is not recorded, which means it's not complete, and therefore it affected the completeness. Then the other one was trade payables, where they didn't pay the fee. So that you can see there's a risk that the trade payables is also understated. Because remember, they're having a conflict. They're saying we're not going to pay our lawyers. So then there's a risk that your client will understate the legal fees in trade payables. And again, remember what is about understatement of trade payables? We're not recording all that we owe our credit or the client or the creditor. Therefore, it's not all the creditors balances is not there. Therefore, it is completeness. Does that make sense? Can I continue? If you want me, I can just show you. Let's see, what was this? This was last year's test. So you can see you can go through this yourself, but you should now have a more better understanding. You see, so here you have to self-identify the accounts that affects and so forth. And you can see the structure. You just basically have to say the risk is that will either overstate, understate, the reason based on the scenario and how it impacts the financials. And then of course, which assertion it will relate to and so forth. Like I said, you have to identify whether it's a transaction or whether it's a statement of financial position and so forth. And that is the solution to that one. Do we have any questions? See, sorry. No questions, okay. Now, audit strategy versus audit plan. So, audit strategy, right, helps the auditor plan how to allocate resources and focus on efforts where risk are the highest. So there, as an auditor, you need to identify certain things in order to now know, okay, we can go ahead and we're going to plan further. So audit strategy is more overall. It's like an overall strategy. It's high level, right? And it's according to you will do this according to ISO 300, and it's part of planning stage. And from the audit strategy, you usually develop your audit plan. So you'll see audit strategy have scope, which is what you're going to audit. It has timing, when you're going to audit, and direction, where you're going to focus on. Now, it's important to note direction means is when you say where you're going to focus on, is usually where was that areas that was very significant. Okay, like that significant areas that's going to impact the more risky areas. Then your audit plan now is like going more into the detail into the audit procedures. The audit plan would have a broken down into nature, timing, and extent. So nature is the type and purpose of audit procedure. Here you determine, are we going to do tests of control with a combination of tests of control with substantive procedures, or are we going to do only substantive procedures because we cannot rely on the internal controls. Timing is again, when are we going to carry out these audit procedures, and then the extent of the work is how much testing will be done. I'm not sure if you can see the difference, but we're gonna go through a scenario now, so you can see what is that. Then again, this is again that an analogy of the gate and lock of that I had in the WhatsApp group and on like I said before, where we say the gate have a control. So if the auditor tested and the locks work properly, then we're happy. The control works. We can rely on the control, because remember, we need to know whether the control works in order to know the nature as what type of procedures are we going to perform. Are we going to perform tests of controls and substantive, or are we only going to perform? So if a internal control work the way it says, 100%, it must work 100%. Even if it works 99%, it means the control failed. It must work 100%. If that control failed, then we can't rely on internal or on the client's internal controls. We're not going to perform tests of control procedures because it'll be useless. We're going to waste our time. Then we're going to only do substantive procedures. Okay. So that's the thought process behind it. So now, 2024 test one, right? UNISA said, identify and describe overall audit strategy, right? They wanted the student to identify 3 scopes, 3 timings, and 3 directions for 9 marks. So you had to give 3, 3, 3. UNISA can ask you to identify and describe overall audit strategy only. They didn't need to give you this part over here. If you see describe overall audit strategy, you know, as a student, you must know you need to discuss scope, timing, and direction. UNISA could have, for example, even asked you just to describe, for example, only timing or only scope. So it's very important to read which one you must give UNISA. Okay. Then the second required is about the audit plan, but let us go through the scope first, right? So we said we're going to go through. So what I did here is, so scope, so audit strategy, I put scope all in blue, I put timing in dark in black, and I put direction in pink. Okay. So if we look at scope, right? So scope is usually you asking yourself, like here you have to ask yourself, like what activities or what, like what the auditor should do, and what activities do we have available to us, or things that can affect the financial statements or laws and regulations that can impact on how we audit, for example. So what I mean by that is, so if you audit a client, right, every client out there would, for example, have IFRS. They must comply with IFRS. They must comply with Companies Act, right? So that is a must. So that will be part of your scope, because as an auditor, you know already that is set, that you're gonna have to do. You always look for things that is out of the norm. Not every client is JSE listed. Not every client have to comply with King 4. And also you look at if there's any other resources that's available to you. For example, if a client have internal auditors, then as an auditor, you can place reliance on that internal auditors. Because if you put them in your scope, it means that if you can place reliance on them after you do your necessary procedures, and you tick the box to say, no, we can place reliance, it means as an auditor, you're going to have to end up or gathering less evidence because you can place full reliance on the internal auditors. So things like that, you look at things like, are they fully computerized? Because remember, if they're fully computerized, it means that you're going to have to use cards. You're going to have to use an audit software to assist you with your audit. So you can see, so scope is all about what additional laws and regulations they have in place, that's going to make us now do additional things other than the norm. Do they have a computerized environment? Is there internal audit? Um, and like in this case, also we said that the company has numerous agricultural sites, which is important because every company usually has stock take. And by having numerous agricultural sites, it means you're going to have to get resources or people within your team to go be on those sites when they're doing stock take. So all of these stuff, so JSE listed was, I made it blue here because I couldn't make it blue there, but the fact that the JSE would have been part of scope. And you don't just say JSE, you explain why. So you say the company is listed on the JSE, so you'll have specific procedures that they need to that you as an auditor should conduct in order to ensure that they're compliant with JSE. They if you look further down here, they King 4 compliant. So you're gonna have you're going to state that, and you say because you're going to have to see and have specific procedures around whether they are King 4 compliant. You're going to state the fact that they have numerous agriculture sites, it means that we're going to have the necessary resources and the necessary time to get staff members to those sites when it comes to stock take. Um, then, if you go further, I told you here that they have an audit committee, so which means they have an internal audit team. So then you're going to say, we're going to consider whether we can place reliance on the internal audit team, because if we can place reliance on the internal audit team and replace reliance on the internal controls, it basically will put us in a better position to be able to make use of the internal audit department and so forth. Then part of the scenario also they said the EPS is operating fully computerized, meaning because they fully computerized, accounting system cards may have to be used in order to assist us with our audit procedures. Okay, so that was scope, right? Then timing. So timing was dark. So if you look at it, again, numerous of agriculture sites. Because remember, we said we did touch time in there because of them being at numerous. So we're going to have time allocated to when the staff is going to go for stock take at that numerous sites. Because the JSE listed, remember JSE will have their own requirements to when they need the deadlines for the audit. And so forth. And because there's the audit committee, so you're going to have to put or end up discussing time to allocate to meet with your internal audit department, as well as time allocated to how we're going to implement the computerized or using cards within the audit. So determining the timing of there. And then the direction now, like I said before, is direction is you're looking at the significant line items, meaning what direction are we going to do for the risky areas. In our case, you could see our risky areas was trade receivables as identified before. So there we'll say we're going to have specific focus on the direction for account receivables because the balance increased significantly and is material. You're going to state there they might overstate their fictitious debtors and so forth. So they might overstate the debtors. So we're going to have specific procedures in place for that. We're going to speak around a little bit around about allowance for credit losses and bad debts. You're going to speak about the going concern assumption there because that is significant. Because remember, because of the bird flu and all the significant increase in costs, there's a lot of going concern issues. So there's overwhelming going concern issues. They never made profits for the last 20 years. So that is also a significant risky area we're going to focus on. And then, of course, the fraud risk, because how Ross said, because of the going concern issues, the to hide the severity of the fraud. So we're gonna have to also implement intense and make some real like have specific order procedures around there around going concern and fraud. JSE requirements wasn't significant there, right? So yeah, but the thing is, we only had to discuss three. So, I mean, we already had three. Does that make sense? Can I continue? The detailed audit plan or procedures can be a draft where they can edit when the audit, when they audit. Okay. So, important to note, guys. So, the audit strategy and the audit plan, right? We say it's in planning, right? In the planning stage of the audit. But remember, it can change even when you are auditing, when you are executing the audit. Because remember, as you are auditing, remember in planning, you only know what you know. As you start gaining now, or as you start performing these tests of control procedures or these substantive procedures, when you're not actually inspecting documents, things can come alight that will affect or change the audit plan or change the audit strategy. Maybe initially you never identified all those risky areas, but when you now go audit, for example, trade receivables, maybe say hypothetically in the scenario, we never identified trade receivables as significant, right? So we never discussed it under the audit strategy. But now when we were in the execution, when we are gaining our evidence for trade receivables, and we now pick up that the significant debtors can't pay their debt, now we see, hey, but this is a significant risk. And we initially said it's not a significant risk. You see, so now you have to go back to your strategy and you're going to have to go back and amend now your direction for your strategy. And you're going to have to go amend your audit plan because your audit plan will now go more into the specific of the audit procedures you need to do around the trade receivables. Does that make sense, Matipe? So yes, we do it in planning, but it can always change throughout the audit because as you're auditing, you do come a light of what things could go wrong, and where you have to go back and just readjust and replan and rework the things and relook at things. You could even speak up um, management lack of integrity later on only, and then that changes a lot of things for your audit. Okay, so that was audit strategy. So you understand scope, you understand timing and direction. Okay. So now let us go to question 14 into tutorial 102, where we now discuss, now look here, they say with reference to background information only, you must discuss the nature and timing of the audit plan. So they only want you to discuss these two. If they don't tell you that, if they just tell you to discuss the audit plan, then you have to discuss all three. Okay. And like I said, so it's important to read. Okay. Now let us go to was Tatya. So everything that I identified in this column is the things that affect timing and nature. Was it? Yeah. So for example, so the order planner, so the nature is all about it's like going into the specifics now. So you identifying specific things within your scenario. So you can see here that let's see. So you'll see the yellow is relating to your timing, and then the pink is relating to your nature. So you see, so for example, in this scenario, as a retail company, online retail, they have to comply with the regulator. This is regulated by the Competition Commission of South Africa, CCSA. So that is an indicator. So the fact that so first of all, we need to discuss nature. You always read the entire scenario, right? Because by reading the entire scenario, you should pick up things like, is there any indication within the scenario that says we cannot rely on internal controls? Because remember, if in the scenario you cannot rely on internal controls, then of course you cannot perform tests of controls. You'll go straight to substandard procedures. If the scenario is silent, you can assume that we can rely, then you will state, like in this case, it's silent. So here, but the first thing you can state, you can say, we'll follow a combined audit approach under nature using both tests of controls and substandard procedures. We'll give you 1 mark. Just to say, we consider if in the scenario they had an issue around internal controls, then of course you'll say, we will only do substantive procedures because we cannot rely on tests of controls because of the weakness in the internal controls. Makes sense? I think there was an issue here with but the only issue here was around the inventory. So they said during the financial year, measuring the inventory balance has presented certain challenges, mainly due to limitations of accounting applications, which affects the classes of, you see. So in this case, there was internal control issues around inventory, only inventory. So yeah, for that specific. Remember, for nature, you also have to discuss specific. So when you discuss the specific, what order procedure you're going to do for inventory, you're going to say, we're only going to do substantive procedure for the inventory balance due to the limitations of the accounting applications, etc. Make sense? Um, and also and when you say you're going to rely, if you state you're going to rely on both test of controls and substantive procedures, you have to say why you're taking this approach. You're going to say, we are taking this approach because we tend to rely on the operating effectiveness of the internal controls. We're happy that the internal controls work. We'll give you another mark. And then you're going to say substantive procedures alone will not provide sufficient appropriate audit evidence. So that's kind of very generic. So you can get 3 marks for generic things, right? Then being specific now. Specific would be saying we're going to do substantive procedures around the compliance of the CCSA. Make sense? Um, and so forth. Yeah, they said that I'm not sure if you read here, but there's a new. So there was a different auditor before. So they put out a tender for us to audit them now, right? So we're new auditors. So specific audit procedures you do would be around the opening balances. Because remember, we never audited them before. So we can't just carry over the closing balances to opening balances. So you're going to have specific or perform specific tests around the opening balances of that was audited previously. Okay. You if you look at it, they say there, our audit firm is the father of the CFO of this company we're going to audit. So you're going to have to do specific audit procedures around familiarity threats between the relationship between the father and the CFO being there. I think you guys get my drift. So that is the nature. The nature is looking into specifics, saying how we're going to test. Remember, in audit strategy, we never said how we're going to test. We never said we're going to test using test of control procedures, sometimes use that you discuss in the audit plan, and you look at specific indicators where you're going to say how you're going to specifically address and test these things. And then, like I said, timing now warehouse in Midrand, which means we're going to again need a staff member to go out to Midrand for order for stock take. The order the audit has a tight deadline. It says it needs to be done within the 2 weeks of the financial year, right? So it means that I'm not sure if you heard, but you get something called interim audit, meaning We don't wait for the year end to finish before we audit. What some companies, for example, if you so this was the 31st of March year end, right? So you won't wait until the 31st of March to like, or you won't wait for the 1st of April to start auditing. Interim audit mean you'll go to the client maybe the 1st of January. Then you'll audit everything from April of the previous year up until say December. So you audit that few months. Then when you return after year end, you audit the loss. So that's what's called by interim audit. So by timing, you're going to say there, only to the tight deadline. Again, you can't just say you can't just say tight deadline. You must say based on the tight deadline, the auditors might not finish in time, therefore they might end up or do interim auditing where they audit before year end and then do verification just prior to year end and so forth. Um, and then, of course, discuss with the timing around the warehouse being in Midrand and having a staff member go in there to do stock take and so forth. Makes sense? Happiness. Let me just show you this scenario or this so you can see. Um, question 1. I mean, question 14. Let's see. So if you look at the solution, you'll see there. You see, so you just these are generic ones to say we're going to use a combination and state why. And then now you're going into specifics. So they had computerized environment. So you can state that. And then now specific risk. So we start discuss the inventory, the CCSA, and saying, you see, so you'll see them always stating what procedures are going to use. See, the substandard procedures will be performed on the laws and regulations. Substandard procedure will be performed on the going concern, and so forth. And then there's the timing. Okay. Let's see if there's any questions. Okay, substandard procedures versus analytical procedures. Please explain. So, okay, I was going to explain this on Sunday night, but let me explain it. So, substantive procedures, right, is split into two. Substantive procedures is test of detail and analytical procedures, right? Test of detail means that you go and test the detail behind. For example, you're going to inspect, for example, a sales tax invoice for the mathematical accuracy of the tax invoice, etc., and that it was placed in the general ledger and so forth, right? So that's actually testing the detail, going into the audit evidence, observing things, etc. Analytical procedures is still a substantive procedure. For the us just me analytical procedures mean is that is when you do comparisons. For example, as an auditor, because we don't just test the detail, we don't just for example, obtain audit evidence by inspecting physical documents. We also, for example, would have where we do analysis. Like, for example, we'll maybe do analysis of how revenue would fluctuate maybe month to month or maybe year on year. So maybe we'll, as auditors, will say we expect revenue to increase by 20% because of maybe we know why. Maybe they have this new product line, so we expect them to increase. But so that is an analytical procedure. So it's comparing year on year, comparing month to month. Makes sense. Even for bonuses, if you, for example, have 20 staff members and they all receive bonus, we'll expect salaries to increase by the in line with your bonus. Makes sense? So that is the difference. Okay, you understand. Great. So that is strategy versus plan. Now loss. We almost there, guys. Now we're discussing planning, materiality, or materiality. Oh, this is too big. So guys, there's 5 steps in calculating planning materiality. First, you need to determine what figures are we going to use. Are you going to use unaudited figures of current year, audited figures of prior year, or budgeted figures? But remember, most of the times we don't use budgeted figures because that's thumb suck amounts. That's not realistic. So you'll always, and whenever you discuss the first part, you have to tell us why you are using those figures or why not. If you say you're using the unaudited current year, you say why you're using it. And if it's not using the others, you say why not. Then you have to then this next step is you have to consider which indicators you're going to use. The indicators are those here as turnover, gross profit, net profit, and these are the intervals. Thing is, that depends also on the scenario. You'll see tests. I think we're gonna do test two. Test two told you, gave you specific information. Hence, some things you could have like just go straight and say we're gonna use this because that is what they use. But if Eunice is silent, then you have to go through the thought process. Okay, if you, for example, gonna use, if like if it's a retail business, you're gonna say we're gonna use the turnover because it's a retail business and they're more about making revenue, and you give it reasons. If you're not gonna use the rest, you must say we're not gonna use the gross profit because of this reason. We're not gonna use total assets because they're not capital in nature and so forth. Then you choose the most appropriate indicator based on this considerations done there. So, for example, maybe you're gonna use revenue. Then you calculate it based on the indicators, meaning this indicators here. And there you look at whether the risk of material misstatement for your financial statement is high, medium, or low. So if your risk of material misstatement for your financial statements is high, right? Then your materiality will be, or which factor you use will be the inverse of that. So if it's high, you use the lower end of the interval. If the risk of material statement at financial statement level is low, you're going to use the higher end. So that's just the rule. There's an inverse relationship between the two. And then you select the base and then you basically calculate it and so forth, right? So that's the 5-step approach. It is in your tutorial 102. There is a practice question in 102 for that, right? That's for plan in materiality. So this whole 5-step approach. Okay. Then performance materiality is derived from planning. So once you get the answer by step 5, you literally take that answer, right? Then you determine now, based on the risk of material statement level now at an assertion level, for example, maybe for revenue, depending if it's low or high, you will determine whether you're going to use this percentage. If the risk is high, you're going to use the lower end. And if the risk is low, you're going to use the higher end. If the risk is in medium, you're going to use the midpoint. Between 70 and 90, what's the midpoint? Is 80. Same with this. If you determine it's medium, if the risk of material statement is medium, it will be the midpoint between these intervals. So the midpoint between 0.5 to 1 would be 0.75, for example. The midpoint between 1 to 2 would be 1.5. Makes sense? Does that make sense? And then, of course, clear retrieval is, Eunice never asked us before, but clear retrieval is where we determine we're not going to worry. Like if something is clear retrieval, it means we're not going to test anything there. And it's usually 5% of PM. So whatever answer you get there, you'll say times by 5%. Makes sense? Then here we said, if risk of material is high, materiality is set as low, meaning the lower end. And if it's low, it's the higher end. Does that make sense? Make sense, guys? And important, did you notice what I said by risk of material for planning materiality? I said risk of material misstatement at the financial statement level. And for performance, I said at an assertion level. Okay, because this is where test 2 came in. Now let's look at test 2. Because we said we're going to look at performance materiality for revenue. Because this Unisa kind of got you guys here. Where's test 2? Okay, here's it. So I highlighted everything in yellow that relates to materiality. Okay. So, and remember they said revenue. Okay. So now here's the thing. So you see here, risk of material misstatement level at the financial statement level was low. Okay. Okay. Before we go there, what did they ask you? They ask you to calculate performance materiality. But what do you do in order to calculate performance materiality? Before you can calculate performance materiality, you have to calculate planning materiality, meaning you have to go through these 5 steps. Okay. And then you can then calculate your performance materiality. So now let's go back here. Test 2. So now, so first of all, so they say calculate performance materiality for revenue. Okay. So so now you must look out for things like what figures do they give us? So when you read through this, so okay, so you see the material risk at financial statement level is low, right? Then they say we're in a retail business. Then in this situation, they say the audit firm calculates using turnover. So here, UNISA basically gave you the indicator. They said its turnover is 0.5. They tried to trick you a bit to speak about net profit before tax, and they speak about, I think they spoke about assets, if I'm not mistaken. But if you look out throughout the scenario, they never gave you any other figures besides revenue. So that was also another indication you had to look at revenue. If you look at revenue, they gave you budget and they gave you actual. In this case, we will use the actual. So first of all, so here you have to do, so step one is discuss whether you're going to use actual unaudited financial, which is the current year's unaudited financials, or you're going to use budgeted, or you're going to use the previous year audited financial statements. In this case, we're going to use the actual unaudited 2025 financial statements because it's the most relevant and set information that's there. We're not going to use budget because it's not necessary, and we're not going to use prior audited. Last year, UNISA asked this question, right? But UNISA had a snag in it. UNISA said that there were significant journals that must still be passed in the unaudited financial statements. In, like, for example, in 2025, if there's things that can end up distorting the amount, then you won't go to budget, but you're gonna go to the audited of last year. Makes sense? So that is number one. So in this case, so we're going to conclude, we're going to use the 2024-5 unaudited figures, which would be the actual figure of 41 million, right? Then you're going to now state, so now we know that, and now you're going to have to go and tell us which indicator you're going to use. You're going to say it is a retail business, so they would be more driven around turnover. Okay, and because this firm used turnover, we're going to use the interval between 0.5 and 1%. Makes sense. So here, that's all you had to state. You didn't need to, if this information wasn't there, but they gave you all the other indicators, and there you're going to have to discuss which one you're going to use, which one you're not going to use, and give more reasons and stuff like that. Then the other thing they said, so that is step two. So we know we're going to use, so step one was we determine which figures we're going to use. We said we're going to use the actual unaudited 2025, which was 41 million. We're going to use the the turnover with the interval of 0.5. Now you need to determine which range are we going to use. So you're going to calculate 41 million times by the 0.5, which is the lower end. You're going to calculate 41,000 times by the 0.75, which is the medium. You're going to calculate the 41 million times by the 1%, right? Now you need to determine what is a risk of material misstatement at an overall financial statement level. Now, the risk at an overall financial statement was low. Hence, so because it's low, what can we do? We can calculate the perform planning materiality using the upper end. So we can use it using the 1%. Does that make sense? Now, now we calculate it. So I think the answer comes to 410,000 if I'm not mistaken. Now, from the 410,000 you calculated as a planning, you're going to now say, now what percent are we going to use, right? It says the range for performance is 70 to the 90, right? But what did they say now? Remember, we use assertion at assertion level, and they say the risk of material misstatement is assessed as low. Okay, that was for that one. But there was another one where they looked at an assertion level. Yeah. Here they say the risk of material misstatement at a assertion level was assessed as high. So because the risk at an assertion level is assessed as high, your performance materiality will use the lower end and will use the 70%. Does that make sense? So it'll be 410,000 times by 70%. Am I too fast? Let me go back there. Let me just maybe show you the figures, or let me show you the scenario. This session is recorded, so you can always go back to it as well. But let's see, where's this test two solution? So you can just maybe get a better picture. Okay. See? So when I came to the calculation, I would just ignore this part because I don't know what was happening in this scenario. But I'm now going to show you. So you see, so for the planning materiality, you'll discuss the 5 steps. So you're going to first determine which figures you're going to use. So like I said, in the actual, let's see, just do, sorry about this, this thing is in the way. Let me just unpin it. Okay, it's not working. Just close all of these. Okay. System test 2. We have the solution. Okay. So, like I said, to determine which figures you're going to use, so if you look at this whole scenario, the only figures they end up giving you around turnover is this over here. So they gave us audited or 2025 current year unaudited figures. The actual, they gave us budget, and they gave us prior years audited figures of 32 million. So the first step is to determine which figure you're going to use. So you're going to say the unaudited is available and is deemed reliable, and therefore you're going to use it. You're going to say budgeted figures are also available, but because those unaudited figures are available, because this figure is available, we're not going to rely on that. And then unaudited figures of previous years are also available, but will not be used because the unaudited figures are available. It's basically saying that one is available. So that's it. That's that 41 million rand. So the 41 million, we're happy. What I told you before is there was another scenario last year where the only time you don't use unaudited figures is if there's a lot of journals that must go through revenue, for example, that will affect the figures for unaudited, because then you'll jump to audited figures of previous year. If you see there's no issues for unaudited figures, you use unaudited. That's usually the first way to go. Okay. So number one is determining which figures. So now we know which figures you're going to use. Then it's to determine the indicators. In this case, because it's a retail industry, we're going to use turnover of 0.5 to 1%. So, and because Pet Pride, the auditors, they use that figure, so we got to use it. So in this case, it was very easy. You just had to state, because the auditors use that figures, we're going to use it. Whereas if UNISA didn't give you this, if UNISA gave you, for example, all these other indicators, then you basically have to explain which ones you're going to use, why you're not going to use it, and why you're going to use it, and so forth. Okay. Then now I'm going to ignore this one because I would just use the unaudited figures. So then you calculate the 41 million that we got over here. The actual 2025 unaudited 41 million times it by the intervals 0.5, which is low, 0.7, which is medium, and 1%, which is high. You get your 410,000, right? Because the reason why you use the 1% was, what did we say? And you must state this. You must say, based on the risk, because the risk of material statement was set as low. So it said there that it was set, risk of material statement was set as low. And they also said that the misstatement at the financial statement level was set at low. So because it was set at low, you go to the higher end of the spectrum, meaning you create the higher end. If that had to say high, you would have created the 0.5. So it's the inverse relationship. So because it is low, you take this answer, the 410, for example. So then your final planning materiality figure will be the 410,000 because that was set as low. Then you just take the 410,000 and you times it by 70%. Reason being by 70% because they said the risk of material misstatement at an assertion level is high. So because when you calculating performance materiality, you always look at the risk at an assertion level. And because the assertion level was high, you would go for the lower end of the spectrum, or the lower end of the percent, because the percent was from 70 to 90%, so you'll take the 70%. Does that make sense now? Matipi, are you happy? Okay. Sorry, I'm sorry that I'm rushing because I had to try to get all these things, out of the way. And I have another meeting at 9 o'clock. But let me now wrap up. So basically, So the key takeaways is you know that audit risk is equal to inherent risk, control risk, and detection risk. Inherent risk and control risk is equal to risk of material misstatement. You should understand what is each by now. Detection risk is managed by the auditor. That's the only risk that the auditor can manage. The other risk is not in the auditor's control. We looked at audit strategy and audit plan. We looked at calculating, planning, and performing materiality. And like you can see throughout this, it's always important to read the required, because you could see we always went through the required before going to the scenario, and also implementing what's in the scenario to your responses. Is there any questions? Any questions? That's basically the end of our session. Any questions? No questions. Let me just see, there's some typing before I end the session. I hope it was helpful and useful, and you understand that better. So if you get the audit strategy versus the audit plan, you know what to discuss. If you look at this at the overall financial statement level versus a surgeon level, you know what to look out for. You know the differences between how it could be asked. What's covered? I don't know what's covered in test three. As a e-tutor, we don't get involved in any planning of the tests. Um, so yeah, so the thing is, everything from lesson 1 right up until lesson 10 is tests, can come in test 3. But remember, it's only 60 marks, isn't it? So there's only that much they can ask for 60 marks. Um, you saw overall financial statement level came out in both tests. I think a surgeon level came out in test 2. They didn't ask you yet audit strategy or audit plan. I mean, tests of controls and substantive procedures come into play, because that would be basically the next stage of the. So stage 1 was preliminary engagement. Stage 2 was the planning, what we discussed in lesson 3. Then stage 3 is basically the execution, which is the now the test of controls and the test of controls and substantive procedures, as well as anything that affects gaining evidence. So that we will discuss basically on Sunday and Tuesday, and then Wednesday I'm gonna have open for anything that want to be asked that you're still not clear on. Yes, so everything, guys. They can even ask you lesson 1, which is all those like the preliminary lesson, when you accept or reject the client, and when it comes to laws and regulations like King 4, CPC, Code of Professional Conduct. Remember, you should know the difference between Code of Professional Conduct for SAICA versus IRBA. It's similar. It's just if it's a CASA, you're going to say they must comply with the SAICA CPC. If you're dealing with a registered auditor, you're going to say they must comply with the IRBA CPC. But the fundamental principles, the threats, all of that is the same. It's just the way you have to discuss it is a bit different. But you'll see that in test 2, you'd see that difference. So you'll see the difference between if someone's a registered auditor versus a CASA. So they will just state that the one complies with SAICA CPC and the other one complies with IRBA, because IRBA is the Independent Regularity Board of Auditors. So they govern the registered auditors, whereas SAICA governs the CASAs. Okay. It's a pleasure. Thank you so much, guys. All the best, and I'll see you guys on Sunday night for, I think, did I say lesson? I think it was lesson 7 and 8, if I'm not mistaken. But see you guys. Bye bye. Enjoy the rest of your evening.
Bye.
Thank you, bye.
Pleasure. Bye bye.